Your office WhatsApp group is going crazy. Everyone celebrating. Paytm allotted, LIC allotted. On the other hand, you apply for every IPO but get rejected 9 out of 10 times. But what if I tell you that getting rejected from IPOs might be the best thing that has ever happened to your portfolio? Today, I'm revealing why IPO listing day is a trap for retail investors. In this video, we'll discuss two types of investors in an IPO: the short-term listing gain seekers and the long-term investors. Also, we'll look at 5 things that each type of investor needs to check before applying for an IPO. Stick around till the end because I'm breaking down actual case studies and the exact playbook I use to buy the same companies but sometimes at half the price months later. I'm CA Vamika and my mission is to bring you clear and actionable frameworks so that you can take long-term investing decisions with clarity and confidence. Alright, let's dive in. Every IPO attracts two completely different types of investors, and understanding which one you are will determine whether you should even apply for an IPO or wait it out. Type 1. The short-term listing gain seekers. These investors aren't buying a business, they are in it for the listing day pop. The usual drill is apply, get allotted, sell on listing day, book profits, pay short-term capital gain tax of 20% and move on. If this is you, here are the key things that you can track before applying. But none of these can assure you a listing gain. They are just indicative. Now let me be very clear. I don't recommend the short-term listing gain approach because you're betting on sentiment, not long-term fundamentals. And sentiment can flip overnight. Okay, so the 5 things to check are: first, subscription numbers, especially from institutional investors like large mutual fund houses, insurance companies, large foreign and domestic investors. Because institutions drive listing pops, not just retail excitement. IPO subscription data is publicly available every day while the issue is open. By day 2 evening, you can see how retail, high net worth individuals and institutions are subscribing. Institutional investors' demand usually comes late, but trends are visible before the issue closes. Some institutions are invited as anchor investors 1 working day before the IPO opens. That data is publicly disclosed. But participation alone isn't enough. You also need to know which institutions can sell and when. So naturally, the second thing to check is anchor investor quality and their lock-ins. Long-term funds provide stability, while momentum-driven institutions can increase post-listing volatility. Anchor investors have lock-in periods. They can sell 50% after 30 days and the remainder after 90 days. But retail investors and other institutional investors who subscribe during the IPO can sell anytime, even on the listing day. This means post-listing, you could see sudden selling pressure when institutional investors exit, causing sharp price drops. That's why knowing lock-in periods and the nature of investors is critical for short-term players. Third, check broad market momentum. Is the broad market trending upwards, correcting, or going sideways? Because even oversubscribed IPOs can list flat or negative in weak markets. Hence, this is crucial for short-term players. Fourth, the company's valuation versus peers. Because overpriced IPOs struggle to pop even with strong brands and good fundamentals. A very recent example is of Lenskart, which was listed in December 2025, but it was trading at 10x price to sales, while its global peer, Warby Parker, traded at just 4x price to sales. That's a massive valuation gap. The result was that despite Lenskart being a household name, it listed 3% below its issue price. Overvaluation killed the pop. But honestly, valuation matters more for long-term investors in my personal view. Fifth thing to check is grey market premium or GMP. Some people swear by it, but be very, very careful. GMP is an unofficial market term where people trade IPO shares before it even lists. This market is not regulated by SEBI. It has merchants facilitating trades based on demand and supply of these unlisted shares. GMP reflects hype, not reality. Let me prove it to you with examples. Look at LIC for example. Most trusted brand, oversubscribed by 2.95 times. GMP was 60 rupees on the day the IPO opened for subscription, suggesting a 60 rupees pop. But what happened instead? It listed 77 rupees below the issue price. So the reality was the opposite of what the GMP predicted. Another recent example is of HDB Financial. The company itself disregarded the unlisted market price of 1225 and instead set an issue price of 740 rupees. If you play this game, accept that you're gambling, not investing. So, the second type of investors, the long-term investors. If you're building wealth for the next 10, 20, 30 years, here's the hard truth. IPO listing day is almost always the worst time to buy. Why? Because there's almost no money left on the table for retail investors like you and me. Let me explain the entire chain. Promoters, venture capitalists, and private equity investors might enter a business years earlier at 50 rupees per share, suppose. By the time the company lists at 500 rupees, they've already made a 10x return and they are exiting. Second player, pre-IPO investors may come in a year or two before listing at around 200 rupees. At the IPO price of 500 rupees, they've already made 2.5x and also start booking profits. Third player, anchor investors. They don't really get a discount, but they get early access and assured allocation. And lastly, there come retail investors like you and me, applying at the issue price of 500 rupees, competing with lakhs of applicants and entering last. So, when you get allotted, it doesn't mean you won. It often means you just became someone else's exit plan. The uncomfortable truth is this: most IPOs are priced to give early investors an exit, not to maximize long term returns for retail investors. So, if you are a long term investor, here's my playbook. Step 1 is to read the DRHP when the IPO is announced. Understand the business model, check the financials, look at who's selling and what is their purpose for the IPO. Are promoters exiting or is the company raising fresh capital? Note the valuation and then simply close your broker app. Now, if you really like the company, you'll have to do your homework. That's when step 2 comes in. Analyze industry trends, check the financials and growth trajectory, evaluate management quality and their track record, and understand the valuation versus industry and global peers. Build your thesis and conviction around the company. Then start building a small position during allotment. Not the full allocation you wanted, maybe 10 to 15% of what you would eventually want to hold. Think of this as a starter position. Step 3. Now track the company's quarterly results for a few quarters. See if the management delivers on what they promised in the IPO prospectus. Step 4. Now patiently wait for the valuation correction. Here's what you're looking for: lock-in expiries, early promoters selling, quarterly earnings miss, or broader market correction. Any of these can trigger the opportunity you are waiting for. And it almost always comes. The hype fades and the stock starts trading on fundamentals, not just narratives. Misho rose by 53% on listing day but came back below listing price just a month later because the 1 month lock-in ended for some investors. Early investors start exiting after lock-ins expire because the IPO was always for this purpose, their exit. That brings us to step 5. To build your full position gradually when the price enters your valuation range. maybe 20 to 30% more every quarter if fundamentals hold and price stays attractive. This is when you go from tracking to buying, when the crowd has moved on, when the stock is boring, and when nobody's talking about it anymore. That's when long term investors build positions. Let me show you with an example again. Tomato listed at 125 in July 2021. If you had built a 15% starter position and then you would have tracked Q2 and Q3 FY22 earnings while the stock remained elevated. By mid 2022, broader market weakness plus Zomato's cash burn concerns triggered a correction to 56 rupees. That's when you would have doubled down. So your average cost would have come to around 65 to 70 rupees. By 2024, it was trading at 180 plus. So why does this work? Because you're buying at rational valuations, not emotional peaks. You have actual quarterly data, not hype. So here's our key takeaways from this IPO strategy video. There are two types of investors. First are short-term listing gain seekers, and second, long-term investors. Short-term investors rely on checks which are indicative and difficult to predict. For long-term investors, first, understand the business model, who is exiting, and the valuations. Second, build conviction and thesis based on fundamental analysis. You can also start building a small position during allotment. Third, track quarterly results. Fourth, wait for stock price correction triggers. Lastly, fifth, build your entire position gradually. If you want me to make videos on my fundamental analysis strategy, then comment fundamental analysis and I'll make a video on it soon. If this video changed how you think about IPOs, show your support by hitting like, sharing your thoughts, and by subscribing to the channel. Thank you for watching. See you in the next one.